Cities redefine resilience as an investment strategy. With the escalation of climate risks and surging insurance rates, local governments worldwide face an urgent financial reality. Cities that fail to adapt face economic erosion, declining tax bases, and increased exposure to disasters. A new report from Resilient Cities Network and Tokyo Marine Group, Under Pressure, Overdue, the Portfolio Approach and Financing Cities for Resilience, highlights the widening protection gap, where uninsured losses from climate impacts are growing faster than the capacity of insurance systems to absorb them. A financial imperative, not an option. Resilience is no longer a peripheral environmental initiative. It's an economic survival strategy. Across the U.S., counties have seen insurance premiums rise by as much as 400%, threatening housing affordability and local competitiveness. The report emphasizes that integrating resilience into city finance strategies is now essential for maintaining fiscal stability. Municipalities that delay adaptation are discovering that the cost of inaction far outweighs proactive investment. The upcoming COP30 negotiations in Belém will further spotlight how cities finance their climate transition, reinforcing that resilience planning must be embedded in every capital allocation and infrastructure decision. Building credibility to unlock capital, the report identifies credibility as the foundation for attracting both private and public capital. Cape Town, South Africa, serves as a model. By embedding resilience into governance and maintaining transparent, audited progress tracking, the city built investor confidence and secured improved credit ratings. This institutional discipline allowed Cape Town to unlock international financing for critical adaptation projects. Similarly, Broward County, Florida, developed its resilience strategy through collaboration between the public and private sectors. Facing repetitive flood losses and surging insurance costs, officials used data modeling to quantify the economic benefits of flood defense investments, revealing a minimum 9% return. The county's resilience portfolio has since become a shared blueprint for regional development and infrastructure planning. The portfolio approach, turning risk into opportunity. The report outlines a portfolio approach built on 6 essential practices that help cities transform resilience from a cost burden into an investment opportunity. It calls for holistic planning that embeds climate adaptation into every aspect of urban development, supported by capital allocation strategies that align public and private financing. Cities are encouraged to adopt data-driven methods to identify and prioritize projects with the greatest impact, while fostering close coordination among municipal, regional, and private stakeholders. Transparency remains central, with consistent reporting practices that strengthen investor confidence and accountability. Finally, disciplined project management ensures measurable outcomes, demonstrating real-world progress and value. Together, these principles establish a framework that positions resilience as a viable asset class, making adaptation initiatives both practical and financially attractive. Canada's Green Municipal Fund demonstrates how public finance can unlock larger private sector participation. Since 2000, the fund has deployed over $1.6 billion CAD to support 2,300-plus municipal projects, catalyzing $75 million CAD in private investment. By using grants and low-interest loans to de-risk initiatives, Canada has shown how municipalities can stretch limited budgets to attract external capital and accelerate climate adaptation at scale. Insurance as a partner, not a payout. Traditional insurance models are evolving. As Tokyo Marine Holdings Managing Executive Officer Brad Eyrich explains, insurance must go beyond payouts. By partnering with cities from the start, we can help price and reduce risk, mobilize capital, and protect long-term economic competitiveness. The report's lead author, Sadiq Kuramboy of Vulpes Investment Management, stresses turning theory into practice. From case studies, we draw practical lessons on how cities, companies, financiers, and tech enablers deliver adaptation and resilience solutions that strengthen urban systems. Our goal is a pragmatic approach for moving from theory to action, built to attract and scale private sector capital. Likewise, Cape Town's Gareth Morgan, Executive Director of Future Planning and Resilience, underscores that cities must operate on extended planning horizons to ensure both durability and flexibility in their resilience portfolios. The bottom line: act now or pay more later. The evidence is clear. Every $1 invested in resilience yields over $10 in benefits. The longer cities postpone these investments, the steeper their future liabilities become. With global climate negotiations on the horizon and capital markets increasingly favoring sustainable infrastructure, the question for municipalities is no longer if they can afford to invest in resilience, but whether they can afford not to.